Good morning and welcome to day 2 of ICESA's Trade Credit Insurance Week 2023. You're very welcome to join us for this conversation this morning about regulatory change, something that we're all very familiar with, at least on this panel. We had a great first day yesterday, kicked off by a keynote address from Mr. Antonio Fernandez Martos from DG Trade, who discussed the developing EU strategy for export credits and fitted within a context of the wider picture of the EU trade policy and how trade is changing more generally. That was a really interesting discussion, and I think we'll pick up on some of that topic later in our own discussion this morning. In the afternoon of yesterday, we also had a fascinating discussion with some of the leaders in our industry talking about where growth is going to come from, how to innovate, and what we need to do as an industry to remain relevant, particularly when it comes to attracting new talent and meeting customer needs. With any of our sessions across the week, you can watch those 2 sessions from yesterday as well as this one later. They'll be uploaded eventually to our website, and if you've registered to attend, you'll receive a link to watch those later. So even if you can't attend any of the sessions that you would like to see, please do register so that you make sure that you get the link. Today's discussion, we're going to look a little bit closer at some of the major regulatory changes that are happening in the world around us. For some of us, this is what we do on a day-to-day basis, but for others in the audience, and I suspect the vast majority, it's something that you hear about from time to time. It's something that you know is happening in the background and know is something that's important, but maybe don't know all the details, why it's important and what exactly is happening. So hopefully we're going to shed some light on where the big changes are happening that will impact the credit insurance sector, the wider insurance sector, and also some of the related sectors like banking and trade finance that are really important to what we as an industry do. And we've got, in my opinion, a very good panel to talk about these topics as well, and I'll invite them to introduce themselves to you. Olivier, can I start with you?
Good morning, everyone. I'm Olivier David from Atradius. I'm heading Special Products, which is a unit that is focusing on the non-CAT part of our business, either single situation, structured credit, and all the political risk.
Excellent. Angus, you're next on my screen.
Hi, good morning, everyone. I'm Angus Scorgi. I'm the head of the Prudential Regulation and International Affairs team at Insurance&Surety, which is the European Insurance and Reinsurance Federation. I mean, day to day, my job is mostly focused on prudential regulation, as you may guess, Solvency II, international capital standards, but also working on other topics such as the Insurance Recovery and Resolution Directive.
Excellent. And Jean-Maurice.
Yeah, my name is Jean-Maurice Elkoubi. I head up credit insurance at ING. So I'm a buyer of insurance for ING, and we've got a decent portfolio of cover, 10 billion plus.
Excellent. And last but not least, Audrey.
Hi, I'm Audrey Zook. I am the Director of A to Z Risk Services, and I am a consultant offering technical services to the political and credit risk insurance sector. I do training, I provide underwriting audit services, and have got sucked into this regulatory world and just trying to defend the insurance and its use by banks.
Excellent. Yes, we all tend to get sucked into this world. I think I've heard people say that about a lot of different sectors, but definitely when it comes to regulation, it seems to be the case. Also a note to our audience that you can ask questions as we're going along if there are topics related to the things we're talking about or other issues that you're interested in when it comes to regulation. Please drop them into the questions tab in the bottom right-hand corner of your screen. As you look at it, we'll be very happy to touch on anything as we're going through or at the end. But Angus kind of touched on it there. When it comes to regulation in the insurance sector, it starts and finishes to a lot of the times with Solvency II. And at the moment, there's a review going on. We at ICESA are following it closely as well. We've got a couple of pet interests, one related to how the internal model is treated. There's a proposal for internal model firms to have to report the standard formula SCR or an estimate of it to their supervisor. We're also interested in ensuring that policyholders are prioritized if there's an insolvency of an insurer, because that plays into how the product is treated in the banking rules. And finally, we're also interested in how the standard formula parameters are calibrated, because we feel that how our sector is looked at is not always the most accurate because of how the line of business for our sector is constructed, and therefore maybe a little bit too conservative for what our members do. But Angus, it's a much bigger picture than those three topics. So maybe you can bring us up to speed on the Solvency II review and some of the key things that we should be looking at.
Yeah, absolutely. So usually when I start discussing Solvency II, I think, at this stage it's worth just taking a bit of a reflection on, where we got to and how we got there. I mean, the Solvency II review started in early 2019 with a request from the Commission to EIOPA on a variety of technical areas. So, I mean, during 2019 and then 2020, EIOPA did a lot of technical work and provided its advice to the Commission. In 2021, I would say the Commission worked on that advice, got some more input from stakeholders and developed the proposals that are on the table. And then in 2022 and 2023, we had the Council and the Parliament both looking at the proposals and developing their own, their own positions for the upcoming negotiations. So, but I think it's clear there's been a significant amount of time, a significant amount of investment by supervisors, by industry, by policymakers. So it's a big review. I know we're certainly hopeful that the outcome of the review is positive, both for industry and also for the other stakeholders. So where are we now? Well, I think about 2 weeks ago now, the trialogue negotiations started with the co-legislators. So we have the Commission sitting on the sideline, and they help the European Parliament and the Council to negotiate the final Solvency II position. So as I say, the discussion started about 2 weeks ago. There's a high level of ambition, I would say, at the moment from all parties we've heard, the Parliament, Council and Commission, that this will be finished or, agreed, shall we say, by the end of 2023. So we have kind of 3 months to get the agreements in place. Now, given that it's taken 5 years to get here, 3 months is not a huge amount of time. So I think, we have to be a bit realistic that this might not happen, but, certainly we're hopeful it will get done because it's been a long time in the making. Now, looking forward, I think there's a couple of other things just to bear in mind. So at the moment they're negotiating the level 1 text, the directive, the changes to the main text. Going forward, we still have to work on, or not ourselves, but the policymakers and the EIOPA still have to define the level 2 text. And there's going to be some important changes happening there as well, which are, it's important to keep on top of. And then, finally, I think the implementation won't happen until probably the end of 2025. So we're about, probably 2 years away from this whole discussion actually impacting companies' solvency positions. So that's a bit of the process. It's been a long process. It's still a lot way to go. A lot of stakeholders, a lot of discussion. But some of the key issues, some of the key content in the review is very important. And I always think it's worth stating at the outset, that the industry is very supportive of Solvency II as a framework. I think it's brought a lot of good things to the industry, and it's very robust and it's built on some very good fundamentals. And I think some of the ones that we like to mention are, the risk-based approach is very well appreciated by the insurance companies. We have the supervisory ladder of intervention, which gives supervisors powers to help with failing companies at an appropriate time. We have 3 pillars. We have capital, we have a qualitative approach through Pillar 2, and then we have reporting and disclosure in Pillar 3. And we also have internal models and standard formula, which allows flexibility for our companies to choose the most appropriate way to measure capital. And then the other thing to mention, I think, is, Solvency II went live in 2016. Since then, we've had a period of low interest rates. We've had a pandemic, global pandemic. We've had an inflation spike and supply chain disruption. And we've had a big push for sustainability awareness, shall we say, across the globe. So a lot of changes, a lot of background changes that have impacted the discussions and it maybe held up things a little bit. But we've always viewed Solvency II positively, but we've always held the view that there are some changes that could be made that would make it much better. And for Insurance&Surety, for our members, I think one of the key things there is the treatment of long-term business. So looking at the life insurance business primarily. And our view was very much, it still is, that some of the measurement approaches that they take in Solvency II are a bit too conservative and result in sort of additional buffers and additional unnecessary volatility in solvency positions. So I think, what we've seen is the policymakers agree with us to some extent, and there's certainly a number of changes going through which will help address some of that excess capital and excess volatility. Definitely not the place to go into technical details, but just to mention a couple. So the risk margins, one thing you might have heard about. Treatment of long-term equity is another one. And then there's something called the volatility adjustment, which is also very important for insurance companies. So alongside the long-term treatment of long-term business, which we think will see some positive, we also we think we're going to see some improved proportionality in the framework, which is very much welcome for those smaller insurance companies, but also some of the bigger ones as well. Where I think perhaps we're missing a little bit and we're not going to hit our target is on reducing reporting. Now, everyone has the ambition to reduce reporting and everyone thinks it's a good idea. But when it comes to the crunch, it's very difficult to agree anything that will make any significant change. So actually, I think on reflection, we're probably not going to see reduced reporting from the Solvency II review. And if anything, maybe a little bit more. And the final point, I think, to note in changes is the sustainability. Solvency II already has a number of sustainability provisions, but it's very important discussion at the present time. And I think having a better reflection of some of those sustainability ambitions in Solvency II is justified. And I think we will see it coming through. So that's a bit of an overview of the discussion so far, Daniel. I don't know if you have any questions or comments on that one.
Yeah, I think that was a really great overview. I think it put a lot of it into context. And as someone who started my career at a UK life insurer about 10 years ago, hearing about implementation of Solvency II at the time and concerns about risk margin and things like that, it's the circle is still not complete and it's coming back around. And I know the UK, looking at its own version of Solvency II, is also looking at changes in that direction and a few other areas as well. I guess you also mentioned the sustainability angle, which we know has been one of the big, holdups. There's been some political wrangling, I guess, in Parliament about how to treat that topic, with some saying that it's already dealt with within some of the modules that are in Solvency II, and others saying they need to have a more specific angle on climate risk or the sustainability factors. Can you touch a little bit on that? What's happening there?
Yeah. I mean, so as I say, in I think it was 2020, 21, perhaps, there were some changes made to the delegated regulation, so the insurance companies had to take a bit more account of sustainability to make it more explicit in the requirements. Now, in the review, what we saw was the Commission put forward three main topics. So it's a review of the NatCat calibrations. So there's a requirement to reevaluate the calibrations for natural catastrophe risk in light of changing climate, which we think is completely justified. There's a requirement for insurers to have a little bit more of an in-depth look at some of the scenarios that would happen under climate change. So, a 2-degree scenario or a 4-degree scenario and what that might mean for their business and their business management. And then there was also a mandate for EIOPA to look at the treatment of, transition risk, basically, and whether we should have more capital for transition risk. So as an industry, I think we accepted all those proposals, and what we saw in Parliament was a bit more of an advanced discussion where a number of ideas came in, a bit more perhaps strong ideas on how insurance companies should more explicitly take sustainability into account. And like you say, that's where there was a bit of a divergence of views. So I think from our position, we understand the initiative, we understand the idea, but I think making these things work in practice and having changes that actually make a difference is a bit more of a challenge. So we'll wait to see what happens there. But I think as an industry, I would definitely say we're supportive of the transition to a sustainable economy, and getting the right regulation in place would certainly be good.
Yeah, and I guess one of the other things is that we sometimes see in the insurance sector is that regulation for insurers tends to follow what happens for banks, and recovery and resolution planning is one thing that's been in place for banks for a long time. There's been developments at the IAIS, the International Association of Insurance Supervisors, at the international level as well. And at the moment, we have the proposals for the Recovery and Resolution Directive for insurers. Can you mention briefly what's happening there?
Yeah, absolutely. I mean, so the Insurance Recovery Resolution Directive, also known as the IRRD, It's following exactly the same process as Solvency II, so it goes to trialogues just now with an aim to finishing by. So I won't mention any more on process. It's basically the same as Solvency II. And as you say, what we saw was sort of not a copy paste, but largely a reflection of the banking rules put onto the insurance sector. And for us, that caused us to take a step back and think. We've advocated for a long time against copy pasting banking rules to insurance because it's not necessary in a lot of cases. I think when we looked at it as well, we also see Solvency II provides a lot of policyholder protection around failing insurance companies. So the need to have a completely separate directive was a little bit questioned, I would say. And the other thing is insurers are not banks. We don't fail overnight. We saw a couple of bank failures over the summer earlier this year. And this just doesn't really happen in insurance. It's much more of a gradual wind down, which gives supervisors a bit more time to do an orderly insolvency. So for us, I think the IRD, the key is, we acknowledge the fact that there are some recovery and resolution frameworks in place across Europe. Having some level of harmonization is probably useful. But I think our view is certainly what's put in place should definitely be proportionate to the risk, and we don't see there being a huge amount of risk, and therefore we don't see the need for a heavy regulation. So we would like to see much more targeted scope for any requirements that are put onto the insurance companies in terms of planning for resolution. And we also would like to see make sure that powers to change insurance companies that are in a healthy state are very, very minimal in case of resolution. So at the moment, some of the proposals suggest that resolution authorities could change, for example, the reinsurance strategy of a healthy company, even though the company is healthy, but just in case there was for some foreseen problem in resolution. So I think some of those powers just need to be applied carefully and really thought through before they're applied.
Yeah. And Olivia, if I turn to you as an insurer, obviously it makes sense for the sector to be secure and resilient and everything else, but how are you looking at it? And I guess there's a link then for credit insurance when it comes to the banking rules, that we want to demonstrate that the sector is strong and resilient in that respect. How do you see it at the moment?
Yeah, absolutely. Thank you, Daniel, and thank you, Angus, for this already deep dive in this sometimes perceived as dry topic. And I can imagine for those of us who are not working on a daily basis on the regulation, and I'm talking more about those who are underwriting or doing the daily business of insurance, it might feel a bit far away, and not really a clear understanding of why is the regulator wanting to change what is actually already working. I think it might be just good to remember the basic in terms of what the regulator is trying to do or are trying to do, because we're talking here today potentially of two regulators, one for insurance and one for the bank. So they are the regulator in Europe for the financial sector. We all know, and that's the basic of our business. That's the our sector is based on confidence and trust. And the only way that we can grow and we can be sustainable, not with the planet, but just economically sustainable, is to keep the trust and confidence of our insured, our customers. And the regulator is trying to help us and to help the entire industry to make sure that the entire industry as such is secure. And for that, and with the fear that we have seen again in Zone 8, Zone 9, not with insurance, but with the banks, but that could have been extended to the entire financial sector. The regulators have thought that they need to bring more confidence in the financial industry to the entire economy, and therefore adding more regulation, meaning more capital. And on that basis, we had both with Basel and Solvency 1 and 2, a standard model and an internal model for calculating the needed capital base for insurance and for the banks. And this has been evolving, requiring more and more capital for the same risk. Now, from an insurance perspective, it's good to improve the confidence of our stakeholders. At the same time, we always need to find the right balance, because if the more capital you require for the same risk, you have two solutions. To attract the capital, you need to increase the price to get some returns that is going to attract the capital, or you need to sell part of your risk to other institutions who have the capital, and that's a bit what's happening partly with the banks that are distributing either to other banks or to the insurance for some risk. And the other solution is taking less risk for the same capital base. If you can attract more capital, you can only take less risk. So the two solutions that I mentioned, either increasing the price, or reducing the risk taking, is not very good for the economy, and it's counterintuitive from the regulator, or actually from the political power that are behind the regulator at some point, to say, okay, what do we want? We want to have a financial sector that is strong and bring confidence, but if it cannot deliver of what we want them to do, being financing the economy, supporting the confidence of the stakeholders to actually take more risk, this is not working. So the regulator is always trying to find this right balance. And we've seen now with Europe, through ICESA, through ITFA, through IOS, through the various professional organizations, we are trying to inform and to share our view with the regulator, so they find this right balance. And that's why we have then all those technical discussions that Angus mentioned earlier. And obviously, there are a lot of details, and it's quite dry. If you're not into it, if you don't work every day on a daily basis, you don't really, well, it's not so important. But at the end, it comes back and bite us back if it's not done properly. So I just want to thank all those like you around this panel that are actually doing some work to make sure that the regulator find this right balance in educating those people who mean well, but don't always have all the information, specifically when they are mostly focusing on the core industry of insurance or the banks. With insurance, they're going to think of life and property and casualty, and not so much into specialty, and even less in the credit insurance. And clearly, we have a different model, and we have a different type of risk that needs education. And so that's where we welcome this activity. Now, as I mentioned earlier, we work closely and more over the past 20 years with banks as a risk transfer. And so we're supporting banks. And I understand now that obviously the regulators needs to, understand each other. We have one regulator for the banks, one regulator for the insurance. Both regulators are working in parallel. And now what we're trying to do is that they talk to each other. They talk to each other to understand how those two industries are actually supporting each other and are making the overall stronger. The overall two industries, they make it stronger, and they also make the economy stronger. And if there was a disruption of either of those industries, you have the entire economy, and especially the trade on which we are working, would be disrupted. If the either domestic or international trade was going to be disrupted, not only by the geopolitics, but also by the fact that there was cash issue, treasury, and also lack of confidence between the different stakeholders, because they wouldn't know if money would be coming or not, or if they can take that risk themselves. So this is paramount for me, and I guess for both our industry, that the regulator understand the right balance and the impact on the economy that this capital requirement or technical requirement that are quite broad, as Angus mentioned, are done properly. So that's my perspective. Sorry for the long speech.
No, I think it makes sense, and I think it puts it into a lot of context. And you mentioned how it's important that we have both sides of the coin, in a sense, the insurance and the banking side, and that they're talking together. And there's a lot happening in the insurance sector, as we heard. And Audrey, if I turn to you, there's a lot happening, obviously, on the banking side, which is very important to our sector as well. Maybe you can put things into the international context. What is happening? Where are we today? And what's the state of play?
Well, Angus mentioned that Solvency II has been under review since 2019. Well, the banking regulations that we're dealing with now and have been dealing with over the past few years are trying to implement Basel III, which was actually agreed finally back in December 2017. So you've had a long evolution and a strong desire to implement it and basically finish the process. But it's the devil's always in the details, and they're very complicated and technical discussions. That, I think, leads to a very strong desire not to deviate from what was agreed. But what was agreed was 6 years ago, and there's obviously been significant developments since then. Everything that Angus mentioned, but also really a huge growth in banks' use of non-payment insurance as unfunded credit protection or credit risk mitigation. And the expansion of insurance support for that means that it's not just trade credit insurance, but it really has now spanned the entire range of bank assets, all of which, as Olivier mentioned, support the real economy. So I think bank interest in this topic and the significant amount of resources that people like Jean-Marie have put into this really shows how important this is as a tool for banks. And I think we're all striving to avoid any inadvertent negative consequences from these complicated technical discussions and drafting that have been happening. And that's even before we get into, okay, once the final texts are agreed, then we need to implement it practically and develop guidance. I find it easiest to think about this as sort of three flows or three main strands where the significant banking markets are trying to implement finally what's been agreed in 2017. So you've got the European Union, you've got the United Kingdom, and then you've got the USA. I would say European understanding and discussions are probably have been the most in depth, which is understandable when you think about the fact that European banks are not only some of the biggest users of non-payment insurance. I mean, Jean-Marie mentioned he's got 10 billion, and he's one of a number of banks who have effectively used credit insurance and need it to continue their lending. And there's also been a significant amount of support of lending into Europe. I mean, some of the data that's coming out of just the insurance sector shows that the biggest markets or the biggest credit exposures tend to be in Europe. And there's been, I would say, also a significant number of consultations and public hearings along the way. So there's been a lot of education, as Olivier said. That's an absolutely key element. And there's certainly been a lot of attempts on that. To the point where sometimes I feel like the EBA is saying, just, could you be quiet about credit insurance? We've got other things on our plates as well. So as Angus mentioned, we've got a trialogue going on the banking regulation as well between the three major EU institutions. And the level 1 text that we expect to be finalized is Article 506, which asks, and again, going to Olivier's point about the two institutions speaking to each other, it asks the European Banking Authority, or the EBA, to, in conjunction with EIOPA, the European Insurance Regulator, to review the appropriateness of risk parameters for eligibility and use by banks of insurance as credit risk mitigation, and look at the effective and observed riskiness of insured exposures and also the own fund requirements for banks using credit insurance as unfunded credit protection. So all of that goes to Olivier's points about capital. So that is expected to be in the final text, and then that report needs to be issued. Obviously, we've got Basel being implemented, and the EBA has an enormous number of mandates as part of all of this implementation going on in Europe. And so the other thing that we are seeking to include, among other sort of specific points, is the need to bridge the treatment of non-payment insurance from what is currently being implemented now under current regulations and to whatever ultimately ends up being done legislatively in response to the EBA report. And that EBA report, from that sheer workload perspective, cannot be done before Basel is implemented. So that's a key point that we are making to regulators. So we expect that to continue finalization of the CRR, the Capital Requirements Regulation, and then implementation along. But that is a long journey. And in the meantime, banks can't stop using what has been an effective tool. The United Kingdom is busy implementing what they call Basel 3.1 in the context of their separation from EU legal and regulatory framework. So they had a more recent consultation in November of 2022, which closed March of this year. And that was on their implementation of Basel standards. And in that consultation, they specifically mentioned that they are going to provide detailed guidance on their expectations as to how credit insurance can be treated as eligible unfunded credit protection. So they've specifically noted, and perhaps because insurance is already a very well-known section of the UK economy, and certainly well-known to UK banks, perhaps because banks and insurers are regulated by the same institution. So they've already specifically said that they recognize credit insurance, and they will be addressing that specifically in their implementation of Basel, which is perhaps then slightly different from the EU, who's thinking about the use and whether or not and how to implement it into their legislation and their regulations. Efforts in the US, I would say, are probably sort of still in their infancy. They're currently consulting on the changes to the final rule that's going to be required as they implement Basel. That consultation closes in November, so there's going to be a significant amount of effort in terms of that education process, and with the idea of ensuring that insurance can be used as eligible guarantee under the US rules. But there's a lot to be done there in terms of education and bringing this tool to specifically to US banks through the acknowledgement that we are hoping for in terms of recognizing credit insurance and how it works. I think it's important to mention in all of these highly technical discussions and drafting that regulators have already acknowledged in the context of current regulations that non-payment insurance does work as unfunded credit protection. So you've had the EBA single rule book back in 2014. You had the EBA assessment of the credit risk mitigation framework in 2018. And again, it opines specifically on credit insurance back in 2020. The PRA in 2019 issued a policy statement specifically regarding the eligibility of insurance and guarantees for standardized banks. So there's definitely something there to build on. The question is, how is it implemented, and do the details, in fact, not do something that negatively impacts? And to that end, we need education, we need data, a lot of which we're collecting. And Jean-Maurice, I give enormous credit for the amount of effort and leadership he's put into some of these efforts.
Yeah, exactly. And Jean-Maurice, as you mentioned in your day job, you are a user of credit insurance, along with other things that you do in your job. But I was going to say, on the side, you also work with ICFA on this topic. But I guess it's almost now a second day job, given the amount of time that goes into it. What you're so deeply involved in it. What are we trying to achieve in the EU context when it comes to recognition of credit insurance as a credit risk mitigation tool, and where do you think we are in that process? how successful are we at this stage?
Right. Yeah. So I've been sucked into it, like many of us. Like Audrey said, thank you, Audrey, for the kind words. You've been so comprehensive, Audrey, in your initial description of the landscape that I don't have that much to add. I would just say, what you outline, that we very much welcome the involvement of EIOPA together with EBA to do that report when they finally sit down and do the work, because of all the good things that are happening on the regulations of insurers, like Solvency II and what Angus mentioned. It is obviously of great comfort to us as policyholders that there is such robust regulation on insurers, especially in Europe. And this whole thing is a little bit of European specificity until the US wake up to that, and that's depending a little bit more on regulatory developments. So EIOPA together with EBA, I think that's a great thing. They will look. I think we sat down recently with EBA, and they will interpret this mandate as a very broad mandate. They will look at eligibility, which they've never really opined on. I think on a few important clauses, it's more the PRA that historically has put their head above the parapet. So they will look into that, and they will look also at efficiency, which is our main horse battle, if you want. So I think there's been discussion on the timing of the report. Clearly, EBA has got too much on their plate until the implementation, so during the whole of next year. So it's very, very unlikely, together with the renewal, the change of the guard in Europe in 2024, both at the Commission and in Parliament, it's very unlikely that we will get a report before, I would say, 2026. And therefore, it is very important to get some sort of bridging solutions until then, because and I don't want to paint an overly dramatic pictures. Some banks are already changing the way they do things in terms of capital treatment of the product, and they won't be so much affected. Some others will be affected. So there is that debate taking place right now within the trilogue, technical trilogues that are supposed to finish by the end of the month, actually. And a cliff effect has been acknowledged, meaning that all our stock of insurance covers that we have, our stock and many of the big buyers' stock will be affected overnight come 1/1/25. So the EBA has kind of acknowledged that they need a functioning market to keep getting data from us and collecting things that are meaningful for them to write a report on it by 2026. So that alone is kind of an acknowledgement that we need a little bit of a bridging solution. We've proposed some drafting, sunset clause or other mechanisms. So we'll see where we get to. That's the last little improvement to the text that we would love to get. But we're humble as an industry, and we're hoping that for the right treatment. We're already very grateful that the Commission took the step to insert that Article 506 and put us on the map for the very first time. So CRR3 will recognize credit insurance and clarify a number of rules and reduce the risk of interpretation by banks. which is a positive for everyone, for us as users, for credit insurers as supporters of our business, both on the loan side and on the receivable side. So we're very hopeful. It's been constructive to date, and we just need that last little fillip to get us over the line, and happy to wait until the report is produced.
Yeah, I think that's very true. And do you get the sense that regulators are understanding, that the people that you're speaking to in the EBA and the Commission, that they're understanding the reason why it's important to have good recognition, and are they also understanding the sector as well? Because that's something that we see occasionally in our conversations, is that the level of knowledge of the credit insurance sector and how it works is not always the highest. And there was a question that just came in as well about how regulators perceive, say, non-traditional credit insurance or credit insurance which is not simply receivables financing. Do you get the sense that they are understanding that, and why it's important to banks?
I think there's a good level of knowledge, because at EBA, certainly, the same teams looking at this file are also inspecting banks and getting to know the nitty-gritty. The European Parliament's shadow rapporteur used to work in the industry, so I think there's a level of, obviously we can always go much deeper and explain quite a few things. We've seen historically that the combination of covers, when you've got, say, a mortgage and a credit insurance, that can lead to different interpretation, and so we need to explain how the product works a little bit more, and so we can't wait until we can sit down with EBA and the EIOPA and really go through the nuts and bolts.
Yeah, Olivier, this is one of the topics that I hear from members probably more than anything else, is what's happening with the banking rules and how are things going? Why is it so important, and what do you think the impact is of not getting kind of suitable recognition?
It is so important because either on the single situation where the bank business represents 70% of the revenue of the industry, but also on the world turnover side, we realize that years after years, most of our insurers actually need financing. So either directly or indirectly, the banks only provide finance if there is co-insurance behind, or the level of financing that they provide depends on the level of insurance that our insured get so the real economy to actually develop, to thrive, you need to have this financing. And the banks can only provide the financing that is needed for the growth of this economy if, because of the capital rules, if they can have a transfer of the risks partially to the insurance industry. The insurance industry itself using reinsurance. So actually the risks are spread across many different entities, which makes the entire industry safer, because you don't have one single entity actually taking the risk that would go wrong. So the fact that the spread is developing so much is helping, and depending on how the regulation is going to judge or impact how the banks are able to use the insurance, it will actually shrink or develop further the spread of the risk and make the industry and the economy safer and thriving. So that's if you look at either the helicopter view or the really micro view, on both ends, you absolutely need to make sure that this right balance is actually working, that the capital base of one player is as important as the balance of the entire industry, of the two industry working together to make them stronger. But this understanding is important at the regulator level, at the political level. As you've seen here, we have a trilogue. Trilogue is the regulator, which are civil servants. They are very technical and knowledgeable, but you also need to have the political power. So you have the governments on one side, and you've got the European Parliament on the other side, the one we are going to elect in less than a year from now. And those people are talking to each other. And at the end, you have 2 out of 3, hopefully will have more power to actually make sure that this is for the people at the end. This is for the goods of the population and the economy. If the economy thrives, the population is better. You have more chance to have social peace and happier people. So this is very important for us because we are so key as a co-insurance industry to the economy, and the banks exactly the same. And by working together, that's how we make the economy stronger.
And I think obviously it's been mentioned before, but timing is crucial to that. I know in the UK they've already announced a 6-month delay to implementation of Basel rules there as well. So there's clearly a lot of pressure on all sides to make sure that this fits within reasonable timescales, and they may slip, I guess. I'm not sure the European ones will because of where they are at the moment, but the UK.
But the UK being one country can obviously be faster than the EU, with a number of countries that might agree to disagree or just have different agenda. It's the same issue that we have to compare with the US or China or Japan, and it's part of the topic when you mentioned the ECA potential regulation. We are facing in Europe a number of different ECA supporting the export, but competing with each other. Where in the US you have one ECA, in China you have one ECA, in Japan you have one ECA, but with also in India, and therefore we need obviously Europe to be more efficient and to understand that everybody is stronger together.
Yeah, exactly. And you're bringing us on nicely to the next topic, which is about the how the EU is looking at export credit strategy, which is a heavily EU focused topic, but does have impacts elsewhere, as we heard when we heard from Antonio Fernandez Martos yesterday. How the EU approaches this topic will have implications elsewhere, both in terms of EU trade and how other countries deal with their own exporters. In a sense, the feasibility study that was recently published highlighted a lot of gaps. So that's for the audience, that's a feasibility study into an EU strategy for export credits, designed to look into gaps that are in the market for exporters in the EU to external markets, and try to provide some ideas of how to address those. DG Trade has that report and is working through it and is looking to implement some of the ideas or work up other ideas to address those. And something that came out quite clearly from that report was that there are significant gaps that exporters in the EU face, particularly in comparison to some other regions where maybe there's a bit more of the fact that there's a less joined up approach in the EU is one of the drivers for that issue for exporters. We, as ICESA, took a good long look at the study. Like I said, there's a really strong overview of some of the challenges that exporters face. We felt that perhaps how it reflected the private market and the private credit insurance market perhaps didn't identify correctly the role that we play or that we can play in providing some of that solution. I think the private market working with and also as a competitor to the public sector is a really important part of how the European market works. And Olivia, I know you've been involved in some of those discussions as well. Do you have anything else to say about the feasibility study and also some of the things we're seeing on state aid at the moment?
Yeah, thank you, Daniel. Well, the reality is, it's true that across Europe, every corporate doesn't have the same service from the ECAs. You have very strong ECAs in the biggest economies, like in France, in Germany, in NL, in Italy, in Spain. But in the smaller countries, they sometimes don't even have an ECA. And even with the countries where they have an ECA, they are competing with each other. We are dealing with a lot of international companies who have several plant in the various countries, and when they have one big contract for export, they need to use different parts made in different countries, and they have to deal with different ECAs, which we have different rules, and we're supporting in different ways. So I can understand from a pure corporate point of view that they want to have across Europe, wherever their plant is or wherever their headquarters is, to have the same type of support than if they were in the US or if they were in China or anywhere else. Now, the comparison with the private sector and the reinsurance industry is quite interesting, because from a private insurance point of view, we offer the same service, the same cover across the entire region and the entire continent. However, I can also see that we don't offer automatically cover to everybody and for any type of risk. The ECAs have a political mandate, and they are supporting the export almost no matter what the risks are. For private insurer, we are going to look at the risk. We are going to look at, does it make sense economically to support this export? And indeed, there is a role for the ECA all across Europe. When the private insurers say, well, I assess the risk and I don't think this is right, the ECA might say, well, this is the country decision or this political decision to support this export no matter what the risks are. And there is a strong role for the ECA. So again, it's true that the private insurers don't offer insurance to everybody for anything because it doesn't make sense economically. But you cannot really put one insurer against the other, the public against the private, because the goal, the aim, and the risk analysis is different.
Yeah, and I don't know, Audrey or Jean-Maurice, I don't know if you have a view on that, because obviously how ECAs are treated in banking rules is slightly different to how the credit insurer is treated, and sometimes that perhaps to those in the sector doesn't always make sense because of how the sector is rated. Do you have any views as from the user perspective on the treatment when it comes to export credit agencies versus private sector?
Do you want?
Audrey, what do you think?
Well, I would just, from a non-user perspective, but I think from a fairness perspective, one of the things that bothers me in some of the regulatory stuff you see coming out, we're trying to get the US to explicitly acknowledge private sector insurers as being eligible in the first place. But you look at some of the EU regulation, and it's almost as if they think that the product works better depending on who the provider is. So you might have additional requirements in terms of provisioning or other things for banks when they're using a private sector insurer, which are completely, not necessary if you're using a public sector insurer. And obviously rating is different if you're looking at the public sector versus the private sector, sovereign versus a corporate. But at the same time, the product is the product, and it should be treated exactly the same way.
Yeah, any other thoughts, Jean-Maurice?
Yeah, no, I'm not as close to the topic on this, and maybe we need to leave a bit of time for questions. So
yeah, for sure. Good point. We have had a couple coming through, which we'll try to get to. Please send questions into the question option as well in the right-hand corner. But as we're coming towards the end of the conversation, Angus, I wanted to come back to you to touch on a sort of a general view of different things. We have several things that are developing at the moment, not just in the EU, but more broadly. IFRS 17 implementation is happening at the moment. We have regulators looking at operational resilience, particularly related to digital issues at the moment. We've got open finance regulation. There's a lot of different things happening. Can you put some of that into context, and how are you viewing regulatory burden at the moment?
Yeah, I mean, this is this is a key topic for us, and I mean, I think it's worth stressing at the outset, that we definitely want good regulation, and as we've just discussed, there's certainly good things happening in regulation. And I think for us, good regulation means it meets the customer's needs. We have regulation that delivers for the customers. And as Olivier said, it's delivering confidence and trust in the system so that people feel they can buy insurance and they can trust the system. I think also that the regulation should, support a level playing field and encourage competition. I think that's another important aspect to consider when we're developing it. But, over the past, say, 10 years, 15 years, what we've seen is just increasing regulation. Now we see, there's constantly reviews. We talked earlier about the Solvency II review. And I think it's clear from our assessment that that's going to increase the size of Solvency II and the complexity of Solvency II, not decrease it, I think, despite everyone's sort of stated intentions. I think, as you mentioned earlier, we also see text legislation getting copied from sector to sector. And, a classic example for us is on sustainability, where we see proposals in Solvency II, and then also horizontal legislation, for example, on transition plans. And it just makes a bit of a mess, makes it more difficult to apply the regulation. So, I mean, I think, as I say, ultimately what we see is more and more regulation. I think the pipeline is still very busy, as you say, with DORA, with open finance, etc. With for us, what's important as well is the retail investment strategy. So there's a lot in the coming years, and I think what we would like to see is a bit of a reflection. Maybe we need a bit of consolidation, a bit of time to work through some of these issues rather than creating more and more ideas, initiatives, regulations. So recently, I'm sure some of you have heard that Commissioner van der Leyen proposed to have a 25% reduction in operational burdens. We very much support that initiative. We would like to see it applied to the insurance sector, not just for the fair share to be applied to the insurance sector. So we really think it would be a good opportunity to deliver on that. It's challenging. It's not easy to see how you can reduce operational burden by 25%, but I think with a bit of hard work on everyone's part, we can certainly do that. So that would be our plea to the policymakers out there to make that work.
We do have some time, so if there's any about a minute or so. So if there is a question that anyone has burning or they really want to get answered, please drop it in. But otherwise, I'll maybe get a quick take. Olivier, is there something in the next 6 months that you were hoping to see when it comes from regulation? What is your goal for as chair of the IC's regulatory subcommittee?
I think clearly what Audrey and Jean-Maurice mentioned in terms of more clarity and support from both the regulator, understanding the value of the cooperation between the insurance and the bank industry, so they let us thrive and support the economy further than we have done already.
Excellent. Jean-Maurice, any final thoughts? Any messages in particular you'd give to the IC's audience about the banking rules and being involved in that discussion?
Yeah, I think what I realized I didn't mention after Audrey and I spoke is the impact on insurers of all this, and I think insurers need to be aware that of what is happening, of the slight uncertainty that will prevail for a while until maybe we have better rules, better clarity, and more favorable treatment overall. But until we get there, I think the buying habits of banks is gonna change, is gonna be a little bit more erratic, and so there might be pressure on pricing. Let's call a spade a spade. So it's important that insurers know about that, keep informed, keep talking to their clients and bank clients, and so it's I wanted to add this.
Yeah, I think that's a very good point to leave it on, and I think it sets the scene very well for the future. What do we need to look at? things are happening at pace, regardless of how involved you are in the discussions. These things are happening and will change. And as you said, Jean-Maurice, there are likely to be impacts, real life impacts on everyday aspects of business, pricing, underwriting, and so on. So it pays to be involved and pays to be aware. But we've run out of time, unfortunately. But I'd really like to thank everyone for taking part. Olivier, Angus, Jean-Maurice, and Audrey, really appreciate your time. Thank you to our audience for providing your questions and for following us along. And I hope to see you later today at 3 p.m. Central European Standard Time. We've got a look at Africa and how the market is developing in sub-Saharan Africa and how to unlock business there. So hopefully you can join us for that. But thanks again to our panel and for joining us, and see you later. Bye.
Thank you.
Thank you.